Welcome, everyone. Welcome to this week's Market Wrap. I have with me, of course, Mr. Pankaj Pandey, our head of retail research, and there's so much to unwrap this week from the Monday scare of Nifty to so many results. We also have inflation numbers, so we'll understand the meaning of all of it from Pankaj sir, of course. So let's begin from the top. What is the outlook forming like on the markets right now, sir?
So hi, good evening, Vishu. Before I come to that, see what has happened in this particular week is that Nifty has obviously, given the selling pressure, has underperformed global peers and is down about 1% in this process. Good part is that broader markets have recouped most of the losses, and they have sort of settled on a flattish note. IT post TCS did very well, and post Infi we have seen taking a profit taking. And whereas when you look at beaten down sectors like PSU banks or power, so some of these have bounced back. And good part is that now we are approaching the key event because of which there has been a lot of nervousness in the market, which is the Trump government coming in. So I think market has been absorbing a lot of negative news, and our sense is that with oversold conditions like these, there's a potential for markets to sort of bounce back to probably 24,200 kind of levels. Now, why we say this is that when you look at, we've seen markets have corrected 12 odd percent and are at crucial levels of 52-week EMA. The overall market breadth has improved. So earlier you had about 8% stocks at 50-day SMA. Now you have 20%. And also, overall sense is that there is a bit of index, say dollar index has retreated from say 110, 112 kind of a levels to a bit lower. And then obviously US inflation has been cooler than anticipated. So overall sense is that once Trump comes in and if he does not really walk the talk, which we find is very difficult task to sort of do, we could see some bit of a relief rally in the market to levels like say 24,200.
Right. That's great to hear, sir. We also saw inflation numbers coming this week with CPI inflation around 5.2%. How should we look at?
So I think US inflation obviously has been coming down, but coming to India inflation, I think there is good news there as well. So CPI inflation for December came in at about 5.2 odd percent, which is largely in line with the expectation. And see, this has been coming down because the food inflation was a big contributor. Food inflation was somewhere about 11% 2 months back in October. Then it came down to 9%. In this last December month, it came down to 8.4 odd percent. So if you sort of exclude the food inflation last 12 months, your core inflation is about 3.4 odd percent. So core inflation has largely been flattish. And I think it is very difficult to figure out in terms of how things will pan out. So for example, on the inflation front, while you have an expectation of 4.5% kind of inflation for Q4 and about 4.3% by RBI, but this was given by the old RBI team, and we need to see in terms of since the new governor is there, a lot of deputy governors have also sort of changed. So I think the monetary policy thought process is yet to be sort of out in open, and which I think will get unveiled over a period of time. But overall, yes, inflation definitely is a positive news for us as well.
Right. We also saw a slew of results coming out. I think the biggest three results this week were from Infosys, HDFC, and Axis Bank. So let's take up these three first, maybe.
So Infosys, when you look at the numbers were quite okay with 1.7% kind of a quarter-on-quarter growth. Geography-wise, also they did well. So North America has a return to growth for them after four sequential quarters, which is a sort of a signaling in terms of positive momentum. Deal wins have also remained very strong, so that is also not a challenge. I think where the stock took a beating or where the sort of sentiment got impacted was while the revenue guidance was revised upwards, say from 3.75% on the lower side to 4.5%, whereas the higher side was maintained. So Q4 is again expected to be a sort of a weak quarter, although you would have lesser number of working days, and then you have absence of some third-party revenues also. In general, I think Q4 being muted is something which is, I think, impacted the stock, especially the sentiments. But good part is that after 10% kind of a correction, we feel that this stock is attractively valued because Infosys can deliver 8 to 9% growth over the next, say, FY26 and FY27. And we feel it's a buy with a target price of 2150, and we have given a multiple of about 26 times FY27. So Infosys, we are not that disappointed. LTIMindtree is sort of a mixed bag kind of a number. There was a beat on the revenue front, but then again, wage hike has impacted not only this, even for Mastek also. So this company came out with a growth of about 1.8 odd percent. And BFSI for them, again, is sort of doing well. So there is an uptick in the discretionary side. So company has sort of done well. But then when you look at the wage hike impact, and that has sort of impacted their optimization efforts by about 50 odd bips. And deal wins have also been okay. So our sense is that growth momentum is going to sort of sustain. But I think companies also sort of reasonably well placed to sort of do well, especially by the TCV expansion, what we have seen. Now, this stock also has seen a correction of about 12 odd percent, and we feel that at about 25% FY27 P multiple. I think it is reasonably priced, which is why we like this stock. And I think this is going to be a key beneficiary of the discretionary spending pickup, which is what is expected post Q4.
Right, right. You mentioned Mastek, so we can maybe discuss that as well in detail.
So Mastek numbers were quite muted. So I think somewhere down the line, I think the company reported revenues which were down about 0.7 odd percent, and EBITDA margins again contracted by 32 pips, largely because of the kind of wage hikes what they have taken. Now, management is taking some efforts to sort of reduce the tail account and looking to sort of improve the margin profile from say 20% to say 21 odd percent. But I think we still need to see some more sort of improvement in the numbers before we turn positive on the stock. So Mastek was muted to say the least.
Right. How about Reliance? A lot of people were waiting for Reliance to come up with results, and they were three in one package actually, because there was Reliance, Reliance Retail, and then Geo as well.
Oh, yes. So Reliance, when you look at the kind of stock performance we have seen, I think any kind of a okay set of a number or a steady quarter or slight improvement kind of a number would have lifted the stock prices higher, and which is what has sort of happened. So they delivered a relatively better Q3 with about 8% kind of a growth in EBITDA and 7% kind of a growth in say bottom line. Retail segment for them did well because of the festive season, and also because of the fact that there's some restructuring which they are sort of undertaking there. Oil to chemical was a sort of a steady quarter. So from that perspective, that segment sort of did okay. But we are not expecting this segment to sort of do very better over the next 1 or 2 years, largely because the crude oil prices have again inched up. And then there is a challenge, especially on the demand side. So we are not too sure whether the petrochemical prices or the GRMs are going to sustain at higher levels. Good part on the company was that Geo reported a decent set of numbers. So we have seen a ARPU growth of about 4.2 odd percent. Then you have more number of customers shifting towards 5G. So 5G adoption from 14.8 crore, it has gone up to about 17 odd crores. So that's a sort of a good set of number. And overall sense is that even in Q4, this tariff hike benefit is going to sort of play out. So Reliance against sort of a kind of a correction what we have seen, and muted expectation came out with a better set of numbers.
Right. How about HDFC's subsidiaries? We had AMC and life insurance giving out their results.
So HDFC AMC, I think, see, the overall performance of the company was quite healthy because this is one company which has been maintaining their market share at 11.5%. SIP AUM also has been pretty strong. So they've got a share of about 13 odd percent. Overall AUM growth on a YOY basis is about 35%. Since the market has corrected, so Q on Q, you are seeing a dip of about 1 odd percent to 7.8 lakh crores. Now, why we're liking this company is more with the fact that the equity component has been sort of doing well, and which is what has sort of come out in numbers also. So equity contribution is going up because equity markets have been sort of doing better. So that has improved to about 66 odd percent. And equities carry better yields. So from that perspective, things will become better for this company as well. And otherwise, all the other parameters were quite okay. So PAT as a percentage of AUM remained steady at about 33 bips. Within the entire BFSI space, I think this, if someone is not looking for any balance sheet risk, then I think HDFC AMC is a far more better company to sort of look at, or AMCs in general. Now, coming to life insurance. Now, life insurance, overall, when you look at the monthly or quarterly, it's very difficult to look at the performance. So if I talk about 9 monthly performance, so they've seen a business premium accretion of about 11 odd percent, and largely driven by ULIP and non-par business. Individual premium equivalent AP, which is what we call, uh, there the growth rate has been quite better at about 24%. And there they've gained market share as well. And I think overall sense is that the margin profile has also seen a bit of an uptick at about 25.1%, which is we called as VNB margins. Although there has been pressure from the change in the business mix because higher accretion in ULIP usually impacts margins. And then there was an impact of surrender regulations also coming in. So on that backdrop, they did quite okay, and which is why I think we are seeing stock sort of doing better from the kind of bottoms it has recently made. So overall, our sense is that again, stock can be volatile because what is not clear is that regulatory restrictions on banker business or also on the other diversification effort. So from that perspective, stock can be sort of volatile. But overall, given the correction, okay set of numbers or a better set of numbers is what I would say.
Right. Absolutely. Another big one this week was Access, I think. How do we look at it?
The Axis numbers were sort of disappointing because when you look at overall growth, quarter on quarter has been sort of coming down. So from 11% kind of a growth, this but last quarter the growth has come down to about 9 odd percent. Now, even on the stress side, when you look at while the credit card plus unsecured or personal loans were witnessing some bit of a stress, so there is no incremental spike in stress there. But what has also happened is that some agri loans have seen a bit of a spike, and the company says it is a bit of a one-off. So from that perspective, I think the fresh spike is something which is not really liked by the market, and which is why you've seen a cut of about 4 to 5 odd percent on the stock. And NIMs obviously has been under pressure. So as a result, they've compressed by about 6 odd bips to about 3.93%. I think what is not really liked by the market is that a private sector bank like Axis is not delivering growth or delivering growth below the overall credit growth of the market. I think that is where the stock has taken a beating, or that sentiment has got impacted, because generally you would want to believe that the private banks will keep doing better compared to the overall system level growth. In that process, they gain market share also. I think Axis Bank faltered on that perspective, and which is why I've seen a cut of 5% in the stock.
Right, right. And finally, hidden gem of the week, which will it be this time?
So yes, budget is around the corner, and our sense is that capital expenditure is going to be in focus. And in again, the capital expenditure, power transmission and distribution is one segment where we are expecting a capex of about 9 lakh crores over the next 5 6 years. And with that in perspective, I would want to sort of recommend KEC International with a target price of 1190. Now, this is one of the major EPC companies in the power T&D space. What they've also done is that they have diversified from T&D to non-T&D as well. So 46% of their revenues is coming from, say, non-T&D business, at least in the first half. So they're sort of very well balanced. Within the T&D space, there is a pipeline of about 1.5 lakh crores, which is what they're looking at. This year, they've bagged orders worth about 20,000 odd crores. and order book stands at about 35,000 odd crores. And like I said, the pipeline is quite strong, and company is expecting 25,000 crore kind of order book or order inflows in this year. And things have been better. So our sense is that margin profile of the company is also going to improve, and which is why we would expect a top line to sort of grow at mid-teens at 15 odd percent. The growth in the bottom line is going to be even more steeper with about 56% kind of a growth rate for the next 2 years. And which is why I feel that this company is in a sort of a sweet spot, given the overall capex and especially the capex in the transmission and distribution space. So we have a target price of 11.90 on the stock.
Great, great, sir. Well, that was it this week. If you have any questions for us, please do put them down in the comments and we'll try to get back with them. Thank you so much for watching, and thank you so much, Pankaj, for your time.
Thank you.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.